Welcome to the Ellsworth Advisors monthly update for February 2025. I'm Kelly Keenan. With me today is Patrick Justice, and today we will review what happened in February from an economic standpoint, go through some economic numbers, also talk about our portfolios, kind of what's been working and what hasn't been working, then also discuss kind of our outlook for the short term and, a little further out. Patrick, why don't you kick us off with the latest economic numbers?
Sounds good. Thanks, Kelly. Good morning, everyone. Let's start with GDP. According to the Atlanta Fed, this is the first time we've seen a drop in the estimate for the first quarter. They're projecting negative 2.8%. We haven't
Annualized, though.
annualized on an annualized basis. We haven't seen this sort of projection since the first quarter of 22. So it's been a little bit. We've been between that +2 to +4% range. But I did read an interesting article. Brian Westbury, chief economist at First Trust, did mention that all imports are stripped out of this figure. And obviously with some of the recent news of tariffs, and that's been a big driving factor on the markets lately, there was a huge run of imports in January. And so it makes sense, given that those tariffs are coming in. I'll be curious to see how this figure evolves over the quarter. It seems like a temporary dislocation at this point.
A lot of the economic numbers are going to start looking not normal. This isn't, we've seen this more recently. Obviously, economic data is never smooth. And with what's going on with the changes the administration is trying to put through, nobody knows the outcomes of tariffs, what the ramifications are going to be, how long will they how long will they be here? Will they be temporary, permanent? They cause inflation, non-inflation. And once again, when you dig into the numbers, a lot of times there's a different story than, hey, the economy shrunk 2.8%, which divided by 4 is, a lot smaller number. But, having a weak first quarter looks like a reality. Now, even going into this, a lot of the expectations have been that, we're going to see slower growth in 2025, not necessarily negative growth. Nobody's really talked about a recession. Yeah, the reality, if it does come in at negative 2.8, we have another negative quarter. There we go. We have a recession. Jury's definitely still out. So we have to be mindful of that. And once again, you dig into this number, Westbury, he brought up great points in his article that, you start looking at what's really going on with the tariffs. Obviously, people are going to want to bring as much in prior to them hitting. So we had a lot more activity of imports, and that does take away from GDP. So that kind of makes sense at this point. Why don't you continue on? What else do we have?
So you guys touched on this last time, you and Cameron, as far as Fed funds go. So left it alone at 4.25 to 4.5. They're going to meet again on March 18th and 19th. I don't really, and a lot of, the market's not pricing in a cut at that point. If you look long term at the year, they're thinking somewhere between 2 to 3 cuts for the year. Now, does the market know everything about Fed cuts, et cetera? They priced in 7 last year, and we had, 3 total. So we'll see. I would think they hold, they stand pat.
It's all based on inflation. If inflation's around 3, which is where I believe it's going to kind of shake out. The more recent reads of inflation were a little lower. Go ahead. Let's talk about inflation numbers.
Inflation numbers. So 3 main factors there that the Fed looks at. So from a PCE standpoint, personal consumption, was up 0.3 in December, was up 0.3 in January. Year over year in December was up 2.6. Year over year in January, up 2.5. So getting closer to that long-term 2% sort of goal that the Fed wants. Core PCE, if you strip out food and energy, which is very volatile, up 0.2 in December, up 0.3 in January, up 2.8% year over year in December, and up 2.6 year over year in January. So okay, and actually cooled a smidge if you strip out the food and energy. From a PPI standpoint, producer price index, another important factor, up 0.5 in December, up 0.4 in January, up 3.5% year over year in December, January. Not surprising there. Third factor, CPI from a consumer price index, up 0.4% in December, up 0.5 in January. Year over year, December up 2.9, year over year in January up 3%. So we'll have some fresh figures here for February in the next week or so, but modest trend. It's okay.
Yeah, still high, still high twos across the board, if
Mhm.
not pushing three. With tariffs, that is going to push some prices up for sure, like it is. Over time, you have some replacement of those goods. You have, domestic competition. So that'll help. Also, one thing about tariffs and from an inflation standpoint, the reality is that is a one-time hit to inflation.
Mhm.
So it happens once. That doesn't mean every single year you're going to increase tariffs by another 25%.
Mhm.
So it just gets bumped in and then inflation may level off. But we're still a ways from that 2% number.
Right.
The Fed's in no hurry to bring rates down for them to,
Right.
Patrick was mentioning 1 to 3 times them cutting rates. So maybe 0.25 to 0.75. That gets us in the mid to high threes for short-term rates, which in a 3% inflationary environment, that kind of makes sense. So, that's kind of what's going on in interest rates. Longer term rates, the 10-year has been hanging around 4.5. With some of the volatility we've seen in the
Pulled up a
market
little bit.
recently, that's definitely come down to about 4.1, which I do believe is a factor of, a little bit of flight to quality. The market's gotten pretty rocky in the last 2 weeks. Also, the other fact that some of the biggest buyers of treasuries are foreign countries. Because when we buy goods from foreign countries, we're giving them dollars.
Right.
Then what do they do with those dollars is they have to park them somewhere. They're buying treasuries.
Yep.
So if it looks like imports are going to slow down, if we're going to stop buying as much because of tariffs, that's could reduce some of the demand for longer term bonds, which could bring down rates. So a lot at play here. Big picture, not major moves. I don't think the rates are moving because of dire circumstances. And, a lot of this is self-induced. We're deciding to put tariffs on. So similar to going back to COVID days where it was, kind of a self-induced recession for the economy. I kind of see these tariffs as the same thing where, we're doing this to ourselves. It is a self-induced type slowdown. And that also means that it can be reversed pretty quickly. So, bottom line, the volatility I think is here to stay for at least, several months throughout the year, but I don't think it's doing real structural damage. I mean, there's structural change going on, which isn't necessarily negative, but we just have to know that it's going to be a choppy year, and we're in the middle of a pullback right now.
Sure. Now, politics aside, do you think there will be some positives out of the tariff scenario? We've already seen some major companies with large investments that frankly don't want to pay the tariffs. I think there could be some pros out of it.
I think the positives are and ultimately you go back to this administration's first term, and one of the things that they were moving down a path of was kind of rewriting all the trade deals. Instead of being grouped into NAFTA or the or the Pacific Trade Bloc, whatever that was, instead of being blocked into these big group trade deals, he was trying to dismantle them and do individual deals with countries. That kind of got sidelined because of the other things that were going on politically, and he never was able to really get that done because of all the distractions. This time around, I think that's still the goal, is to really renegotiate the whole world trade. And hey, can it be any worse than what we have now? Not that it was bad, but reshuffling the deck, I think it'll be as good as, if not maybe a little bit more favorable to the U.S. moving forward, and a little bit more fair, equal footing. That's probably the end result, which I don't think is necessarily negative. Yeah, I mean, it should be positive.
But in the short term,
in the short term, in the short term, you're always going to have, you're shaking up the boat. So things are changing. If you were doing business a certain way, that could change the way you're doing business. So it can hurt some businesses, but then again, there's also going to be other businesses that are helped. So that's really the environment we're rolling into.
Okay.
What else do you have on your economic?
Last piece I had was just an unemployment standpoint. We'll get a good fresh look at February numbers, but projections at this point, they're projecting 160,000 new jobs in February, up from 143,000 in January. They're projecting unemployment holds steady at 4%. I think that would be a win given some of the recent, efforts of Doge and layoffs and things that have happened and trying to shrink some of the Fed, you know, National Park Service and some other,
Right.
sectors that have been hit pretty hard in layoffs. So we'll see where that comes out, but we'll take that if that number comes to fruition.
Right. That's going to be interesting. I mean, the government stuff, there's give and take, definitely a lot of media around it. How that eventually shakes out is hard to say.
Yeah.
It could be just a matter of, hey, we got rid of people, but we bring in our own people, and will they cut too deep? We don't know. Kind of the one negative that I'm seeing from just with clients and seeing locally is we are starting to see some layoffs happening. We've seen it in the, financial services. We saw it starting last year. You've seen like locally mowing. They're doing,
Yeah, they're
people,
restructuring.
they're
They're
restructuring, moving to Chicago, which is
Yep.
obviously opening the door for them to get rid of people. Because if they don't, if you don't want to move to Chicago, you lose your job type situation. I mean,
Yep.
people are deciding to stay in Cleveland. I think recently Sherwin-Williams, is doing some soft layoffs now. So we're kind of seeing a little bit of a shakeup there. I mean, that's a normal course of doing business. There's definitely some fat trimming happening.
Yep.
Is what happens, and it has to happen. You need to get rid of some of the dead weight. Restructuring is happening, and that is the environment we're in. The fact that it's happening in a reasonably healthy economy, that's good. I think it's good, puts the brakes on things a little bit. And, in the grand scheme of things, like you said, it's going to cause short-term volatility, which we are absolutely seeing right now. Um, Relating that to the stock market, parts of the market, what's driven the market are, the 7 largest tech stocks that drive the S&P, drive the NASDAQ, and their valuations have gotten pretty stretched. I mean, they're at levels that are historically some of the highest levels we've seen, even, going back to 2000, 2001 during the dot-com, tech wreck. Seeing valuations that exceed that at this point. And if your stock is at a, you know, higher than normal or obscenely high valuation level, anytime you start getting rumblings in the news or changes to the economy or changes to the rules, those stocks are going to be most susceptible to downside volatility. So
Overvalued, little rich.
the more overvalued, the more susceptible you are to bad news, and we are definitely seeing that in the economic numbers and the market numbers. Kind of jumping right in, you'll see in in February the S&P down 1.42, the NASDAQ down 3.97 just during the month, and there we go. Those two are highly driven by the big tech companies. The Dow Jones also kind of took it on the chin, down 1.58. Part of that was United Healthcare. They're a heavy weighting in the Dow, and
A little drama in the news.
they had some drama in the news, which I don't think was news to some people that understand the health business.
Right.
That's
Yeah.
kind of how it works. Small cap stocks, the Russell 2000 for the month was down 5.45, so pretty rough month there. International stocks held up pretty well last month, up 1.8. Emerging markets up 0.36, and then the bond aggregate bond up 2.2, and that's kind of reflecting the reduction of longer term interest rates. Coming off about 4.8 down to about 4.5. That helped, and this is just through February, which was last week. I'm thinking we're further into March. Yeah, so a lot has happened, especially at the end of the month. Year to date, though, the S&P is still positive, up 1.24. Dow Jones up 3.05, so a good start to the year for the Dow. NASDAQ down 2.4. So we're seeing the biggest exposure to tech is having the hardest time this year. Small cap stocks, which had a great year last year, this year we're down 3%. The reality there is the Russell 2000, which kind of measures the small cap universe, that's 2,000 stocks. There are a lot of stocks in there that don't make money. So, but there's also a lot of stocks in that index that are making money, that are really good investments. So if you're a lot more selective in the small company area, there's a lot of good opportunities. And, the reality is that's probably where a lot of the opportunities are moving forward, because you can be a lot more selective and it's a broader. And there's a big distinction between the best company in the Russell 2000 and the worst. Between not making money and making money, there's a lot of disparity, a lot of chance for our opportunity.
Well, and it's just about once again, you mentioned the small caps. It's about where you place the risk, right? If you're willing to take the risk in certain spots, you can, but got to be careful.
International year to date, once again, the EAFE up 7.11%. So this is the best showing out of international stocks in a long time. Emerging markets up 2.03%. And once again, year to date, the aggregate bonds up 2.75. So pretty solid start there. Our portfolios in February, growth of income portfolio up 2%, or actually 1.9%. Year to date up 3.7. So doing all right there. Big gainers in February, Berkshire Hathaway up 9.6, Nucor up 7, Microchip Technologies up 8, J&J up 8.5. So kind of some more people would consider value oriented, or more your traditional type companies. No, really, Microchip, they're analog chips, so I wouldn't, they're tech, but not,
Hmm.
they're not Nvidia or like that. Laggards, Iron Mountain down 8.3. Iron Mountain's been a good holding for us. A little bit of rumblings about, through the Doge, Iron Mountain, they store a lot of paper data, but they
Hmm.
also do a lot of electronic storage. We looked at that, and, government revenue is, I think, less than 5% of their revenue. So, yeah, on the headline, we looked, oh, this is going to impact them. Bottom, I don't think it's really going to impact them that much at all. So we're holding tight with them. Had a rough month, but we're still well ahead of the game there. Lennar down 9%, Toyota down 4%. Year to date, Nucor's our big winner so far, up 18%. Raytheon's up 15%. Visa's up 15%. J&J up about 14%. Laggers, once again, Iron Mountain down 11%. Lennar down 9%. Nvidia, kind of rough start to the year, down 7%. Even last day or so, Nvidia's been taken out of the chin. So, rough sledding for Nvidia at this point. Once again, probably from a valuation standpoint, very highly valued. A lot's got to happen right for them to
Yeah,
make
they had a good earnings number, and market didn't seem to care.
right.
So,
You need a lot of growth to justify the price in there. So, you know, yet to be seen what's going to happen there. Dividend yield for the month up 2.7, year to date up 3.5%. AT&T a big winner in February, up 15%. Once again, J&J up 8.5%. AEP up 8%. Amgen up 8%. Laggers, T. Rowe Price down 9.6. Target down 10. HP down 5. Year-to-date gainers, Amgen up 18%. So we're seeing some life out of the healthcare. AEP up 15. Duke Energy up 9. Chevron up 9.5. Laggers for the year, Target down 8%. T. Rowe down 6.5. Packaging Corp down 5. Packaging Corp's been another one that's been a big winner for us, just giving a little bit, give me a little bit back there. Appreciation with income for the year, for the month, up 0.7. Year to date, we're up 5. So a little bit of give back in February. Big gainers in February. Eli Lilly up 13.5. PNW up 6.4%. Cigna up 5%. Laggards, Broadcom down 10%. Lam Research down 5%. Microsoft down 4%. Perfect example of, kind of some of the tech stuff getting beaten up. Year-to-date gainers, Eli Lilly up 19%. Meta's up 14%, even though it's in the tech world. It's held up fairly well. 14%. Sunoco up 14%. Year-to-date, our laggards are Broadcom down 14%. AES down 19%. Microsoft down 6%. Price potential, we had a good January there this month. Once again, Google, Salesforce, Nvidia brought us, Google, Salesforce brought us down. Vistra Energy for the month down 4.7. Year to date down down 0.23. Gainers, Jazz Pharmaceutical up 15% for the month. That's nice. Merck up 7.7. Nvidia up 4 for the month. Laggers, Vistra Energy down 20. Google down 16. Salesforce down 13. Fresh Del Monte down 13. Gainers year to date, Jazz Pharmaceuticals up 17. CLAC up 13. Year to date, laggards, MYR Group down 18. Dell down 18. Google down 10. Salesforce down 11. So we still have some heavy hoeing go in price potential, but it's going to be a volatile year in there. Small cap, here's where the big numbers are. Our small cap portfolio for the month down 6%, year to date down 6.5%. So, basically wiped out a kind of a weak start to the year. February gainers, WGS up 37%, PLMR up 19%, Red Violet up 12%. Our laggards though, Graham Corp down 25. Graham Corp's one we made a lot of money in. I think we're up a couple 100% in there from the get-go, so we gave some back there. Addis down 25%, VERX up down 14, and Prax down 49%. I'm sorry, VERX is down 44%, Prax down 49%. Gainers this year, PLMR down up 21%, Northeast Bank up 9.5%, Cobalt up 13, Red Violet up 13, laggards, Prax is killing us down 50, VERX down 40, Graham down 23, Addis down 24. So small caps are going to be volatile. We had a great year last year, giving some up, but it's going to be going both ways. Starting this month off, it looks like, starting the month off, we're into the middle of a pullback. Last year we saw this several times, between 5 and 8% pullbacks, July, August, and then at the end of the year. I think we're in the middle of one right now. Will this thing get to the 10% level? Very well could be. I don't think it's the big one yet, or, I don't think this is the big one. I think it's just, we're going to see a lot of this. It's early in the month. By the end of the month, we could very well be positive. I think it's going to be a roller coaster back and forth the whole way. Ultimately, I do think we'll have some gains this year. We're not heavy into the NASDAQ stocks. We're not heavy into the stocks that are driving the S&P. So I think we very well can, kind of buck the indexes this year.
Yeah, it's like you said, it's early at this point. There is certainly some sticker shock and a lot of reaction to a lot of policy that's being put in place.
Oh, absolutely.
Certainly seems like a good time if you are, feeling uncomfortable, allocation-wise, et cetera. That's what we're here for. So obviously do not hesitate to reach out to your contact and your advisor here. We're here to help you through that, right?
Yep.
It's a psyche battle. We often forget that these sort of corrections and pullbacks or drawdowns, whatever you want to use, they're common in the market, right? We've had good years the last few years. Don't hesitate to reach out.
And also, we're individual stocks. So individual stocks, the prices move a lot, but that's why we're diversified, because for every one that's down, you have one that's up, to the same magnitude, or maybe a little bit less either way. That gives us a total portfolio return. And the key now is, because we're going to see a lot of volatility, what's really important is when clients know that they have big expenses coming up, they're going to need, large chunks of cash out of their portfolios, beyond just their regular monthlies, let us know, because we can start positioning dollars ahead of time, so that, if they need the money in the middle of a pullback, we're not selling when things are low.
Right.
We have the money ready to roll. That's why we have money in safe areas.
Yep.
We're always going to have some money there, but if something new is coming up, definitely let us know.
Absolutely.
Buying a house, putting big down payments down, a car, whatever. The sooner you can tell us, the better, because then we can prep for it.
Yep, absolutely.
That's all we have for now. Have a great month, and thanks for being clients.
We'll talk to you soon. Thank you.